Hello all, welcome to your schemes. I'm Ilakya. I hope you are all doing well. It is very important to get a good understanding of income tax benefits in mutual funds. So today in this video we are going to see all about income tax benefits in mutual funds. We will see section 80C benefits, dividends payout tax, capital gains tax, TDS, that is tax deducted at source. Without further ado, let's start the video. Start with section 80C benefits. So effective April 1st 2020, section 80C benefits will be available only on the old tax system. They are not allowed under new tax system. ELSS, equity linked savings scheme, provide tax benefits under section 80C of Income Tax Act. So investments under this scheme of up to rupees 1.5 lakh in a financial year will qualify for tax deduction under section 80C. We will discuss the tax on maturity and withdrawal amount in later section of video under capital gain tax. So please watch the video till the end. Let's move on to dividend tax. In the past, for an investor, the dividend received from a mutual fund company was completely tax-free. But for the mutual fund company, the dividends declared were taxed and it is known as dividend distribution tax, DDT. The DDT rate was 10% of equity funds and 28.84% for debt funds. And mutual fund company was responsible for paying DDT to Government of India. In this case, the NAV of the fund came down to the extent of DDT deducted. Effective April 1st, 2020, DDT will be removed. It means that the mutual fund company won't deduct DDT while paying dividends, but the dividends will be taxable for the investor as per the income tax slab. So if you receive dividends from a mutual fund company, then they will be added to your income and then they will be taxed as per your income tax slab. You need to be aware of this before opting for dividends payout in mutual funds. Next is capital gains tax, that is CGT. The profit that you get when you sell mutual fund unit is known as capital gains. Okay, and the tax applied on these gains is known as capital gains tax. So capital gain tax can be divided into short-term capital gains tax, long-term capital gains tax, and these depends on type of mutual fund, whether it be equity or non-equity, and it also depends on investment period. For equity funds with long-term capital gain tax, if you invest in equity funds for more than 1 year and make profits, then it is known as long-term capital gain. From April 2018, there is no tax on profits up to rupees 1 lakh. After that, any profit is taxed at 10% without indexation. Next is equity funds, short-term capital gains tax. If you invest in equity funds for less than 1 year and make profits, then it is known as short-term capital gain. The tax rate is 15%. And hence you have to pay 15% tax on your profits. Next is non-equity funds. Under this, long-term capital gain tax. If you invest in non-equity funds for more than 3 years and make profits, then it is known as long-term capital gain. The tax rate under this is 20% with indexation, and hence you have to pay 20% on your profits. Next is non-equity fund, short-term capital gain tax. So if you invest in non-equity funds for less than 3 years and make profits, it is known as short-term capital gain. The profits will be added to your income under income from capital gains and you have to pay the tax as per your income tax slab. Let's move on to TDS, that is tax deducted at source. In the past, there was no TDS concept in mutual fund investment. But after April 2020, there will be TDS on dividends paid to the investors. If the dividend to be paid is more than 5,000, then the mutual fund company will deduct 10% of the dividend amount as TDS. If excess TDS has been deducted, then you can claim it while filing your income tax returns. If you feel this information was helpful, then please hit the like button. It means a lot. For more similar videos, please subscribe to Your Schemes. Thank you. Have a good day. Bye-bye.